Hey, Jason here. In today's investment analysis video, we are going to cover Walgreens after we covered CVS last or 2 weeks ago now. Before we get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: iTunes, Stitcher, SoundCloud, Anchor, Spotify, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. And if you like this the video, make sure to like, love, share, subscribe, and hit the notification bell so you're notified every time we release a new video, and we release new videos all the time. Okay, so now I'm going to get you to my screen from the analysis. There we go. Get this out of the way. Okay, so 2 weeks ago now, we covered CVS. I said they look like a pretty good investment. All that good stuff. You can go see all the details for that video and our other investment analysis videos where we cover stocks like ExxonMobil, Cody, Smile Direct Club, U.S. Steel, Archer Daniels Midland. We cover a bunch of stocks. Those are in the links below. So if you want to look at the CVS video in particular because you care about which one is better, frankly, use the CVS video for reference, or go to the other videos I mentioned, again, in the links below this. If we come across anything that I've referenced before, like book value, impairments, cash conversion cycle, stuff like that, I'll tell you specific videos to go to. And again, those links are below this. So first thing catching my eye here is their 5% dividend. Solid, quite high, frankly. I think I said in a past video, or I know I said in a past video, that if you have a company paying a dividend above 5%, you need to be careful. This is right under that threshold. So not necessarily a red flag, but again, anytime I see a dividend over 5, I become skeptical. It's not always a bad thing, but oftentimes it is. So I become skeptical immediately as soon as I see that. Again, I don't really care much about PE, but this is one sign the company might be undervalued. This is a big deal. Normally this section doesn't matter at all. Apparently Amazon is continuing its world domination tour and trying to take over pharmacy stuff, which I have no doubts that they will, because they dominate everything else, and they already deliver stuff to essentially everywhere in the world. So this is a major risk, frankly, for Walgreens and CVS. Yeah, so that's potentially major issue there. Walgreens. I'm assuming this annoys me every time I look at Walgreens, and I haven't looked at them in a while, but this annoys me. Does anybody know why they're called Walgreens Boot Alliance? I would assume that there was some kind of merger in the past, but I have no idea and no context as to why that name is. So if you know why their names is Walgreens Boots Alliance, let me know in the comments below. Greatly appreciate it. First thing I notice here is huge jump in revenue. It's almost doubled from $72.2 billion in 2011 to $140 billion rounded up in the trailing 12-month period. It's a huge jump for a large company. What's its market cap? So that's interesting. Its market cap is $32.9 billion, and it's doing $140 billion in sales. So that's incredibly interesting. Operating profits have cratered this year, largely due to COVID stuff, which is not surprising. Actually, I'm going to bring up CVS now for some context to this. I want to just put them on my other screen. I'll tell you the numbers, but I don't want to minimize that screen. Oops, don't want to do that. I'll pause this real quick while okay, and we're back. I got this up on my other screen. You do that later. Okay, so I'm just going to read off some of the numbers here. I don't want to bore you to death with going back over CVS. If you want the full details, go to the video in the link below, but I just want to get this for context here. So as of this writing, or as of this recording, CVS has a market cap of about $87 billion. Versus Walgreens and its $33 billion market cap. Rounded up. Walgreens margins have about cratered from 3.5% at the end of 2019, or at the end of the 2019 fiscal year. I can tell by this right here, this August 2020 time frame, that they have a different financial year than most companies. Most companies end at in December, of course. So in the full year 2020, they've had a 0.7% operating margin, while CVS numbers have actually gone up to 5.4% from 4.7%. 5.4% in the trailing 12-month period. 2019's operating margin was 4.7%. So this, and we'll see this going forward, but something to note here is, I would assume from this that Walgreens is a better, or CVS, sorry, is a better run company than Walgreens from these, just these kind of numbers right here. Payout ratio is obscenely high, 3.5 times its earnings. And even before the COVID crash, so we're over here. Before the COVID crash, it was fine. After COVID, locked many of the stores. Actually, I don't think any of the stores got locked down, but people are going out less, buying less stuff in stores, which lowers revenue and lowers margins. Shares, they've been buying back shares. Value per share going up over time. I explained that in several videos. I think Cody, ExxonMobil, to name two that I talk about. That's generally a good thing, except when it involves a lot of goodwill and intangible assets. Free cash flow, still relatively good. In the trailing 12-month period, I would assume this is because they brought in more debt at $4.1 billion, because it's actually up from 2019. I would assume, and $3.9 billion rounded up, I would assume that's because they brought on more debt. ROIC's cratered. Again, not surprising. Now ROIC is actually a lot less than at, let's go back here. It is, the trailing 12-month period, the ROIC is 1.8 versus Walgreens at 6.6. So what all these margins mean is that in general, CVS is about 2 to 3 times better when it comes to profitability margins than Walgreens. To give you a real world example of what that means, think of somebody running on a treadmill. The way I explain this to students is, if your profit margins, in this case, in CVS's case, are 2 to 3 times higher than your competitors, your major competitors, then you essentially make 2 to 3 times the profit, while they run 2 to 3 times faster to catch up with you. That's, again, it's not an exact comparison, but it is similar enough that to me that makes sense. And I tell that to a lot of my students, that essentially what Walgreens is having to do here is it's having to play catch up, and it's likely to fall farther and farther behind unless they can get their stuff under control. Free cash flow to sales, again, about 2 times less, a little bit under 2 times less at 3% in the trailing 12-month period versus CVS at 4.8%. Their cash levels are surprisingly low, while their debt did not go up. That's actually a little bit surprising. Their long-term liabilities went up a lot, from 9.8% of the balance sheet in 2019 to 30.9% of the balance sheet in 2020. So I'm wondering if they're, instead of taking on kind of quote unquote normal debt, if they're taking on some kind of other debt, operating leases. They're restructuring some of their contracts into operating leases from debt, something along those lines, to kind of hide their debt levels. Again, I'm not saying they're doing it in a bad way, but it just won't show up the same as debt. Nothing else here. Cash conversion cycle. Down for both companies, typically a good thing. Don't see anything there of major note. Okay, for Walgreens, this isn't a great thing. 2.2 interest coverage ratio. Typically, you want this as high as possible. Anything above 1 means with current profitability, you can cover interest payments on your debt. With profits from operations, again, that's a good thing when that happens, but typically you want this to be as high as possible because that gives you more margin of safety. Again, for debt to equity ratio, I look for anything under 1. So this is at 1.95, not a massive deal, but it's not necessarily a great thing either. Oh, wasn't necessarily expecting that. So their total debt is $40 billion, Walgreens, versus a $32.8 billion market cap. Versus, so their net debt, because they only have $520 million in cash, versus $40.1 billion in debt. So even their net debt position, after you subtract cash, is more than their market cap, which again, I've explained in a couple other videos. When that happens, it's pretty rare when this happens, but when this happens, it essentially means just based on the book value of the company, that based on this, after you subtract the debt from the cash and the market cap, you have a negative equity value left over, which essentially means your shares are worthless. Yes, that's not an exact comparison because the company has operational value and that adds value to the stock as well, but market cap is supposed to consider that. Excuse me. Inventories, ton of inventory. Not seeing anything major here. So they lease their property, it looks like. Lease property, plant and equipment. So they don't own it. At least a good portion of it they don't own. Which is, frankly, there's positives and negatives to that, which I'm not going to get into today because that would take me off on a tangent that I would talk your head off for another 20-30 minutes. Goodwill has gone down. I'm assuming they impaired some stuff over last year. Again, I talk about that impairment in the Cody video and the ExxonMobil video. Not a good thing. Equity investments. So they have about $7 billion in equity investments. That's interesting. So subsidiaries, private companies, something along those lines. Debt. So their current debt is $2.6 billion versus, that doesn't include their capital leases. So including debt and short-term debt and capital leases, about $6 billion. For Walgreens. Aha. So I told you in the other thing back here on their financial health that their other long-term liabilities kind of skyrocketing likely meant that they're putting, instead of just kind of typical debt, which is 14% of the balance sheet in 2020, I guess they just finished up their financial year. And other long-term liabilities skyrocketing from 9.8% to 30.9% in 12 months, that they likely were maneuvering some of their debt into other things like operating leases. I was wrong on that part. They've been maneuvering them into capital leases in the last year. So back in the end of 2020, they had zero, according to this, $0 in capital lease obligations. And they had $11 billion in debt, in long-term debt. Now they have $22 billion in capital lease obligations versus 12.2 billion in long-term debt. So this is where the huge spike came from, and why on a balance sheet perspective over here, their balance sheet looks relatively normal. But when you see huge spikes like that, you need to look on the balance sheet to see what they're kind of doing. Again, there's nothing illegal here. But it's just a different way, different kind of debt, I guess is another way to put it. Instead of showing up as kind of quote unquote normal debt, this shows up as a capital lease, which has different accounting rules and makes some of the metrics for, I was going to say Wells Fargo, for Walgreens look a little bit better than they are, which again also affects their debt to equity ratio, which is already above my threshold. When you include their capital leases, it would skyrocket. So this again, I've said this in many videos in this series, this again shows you why you cannot rely just on looking at the numbers. You have to look into the numbers and know what they mean when you're looking at an investment. Okay, nothing major there. Oops, let's go to the cash flow statement real quick. See what those capital leases have done to the capital or to the cash flow statement, if anything, in a major way. Yep, they impaired about $2 billion worth of stuff in impairment of goodwill. So they impaired about $2 billion of goodwill. Again, I explained what that means in several other videos. Cody and X on mobile come to mind. They've been buying back some stock still, it looks like. They've been issuing a ton of debt. So they've issued in the last 12 months $12.4 billion in debt, and they've paid off $21.4 billion in debt. So essentially what they've been doing is they've been issuing debt to pay off other, hopefully higher yielding debt, with newer debt at hopefully, again, lower interest payments, lower interest rates. I had to take a drink. And nothing major on the cash flow statement. The big thing here for me would be figuring out what those capital leases are, which actually I'm so interested, I'm going to go to their website. And I'll pause this real quick and I'll be back once I have their website up. So unfortunately, it looks like their 10K is not out as of this recording. So I'm looking at their press releases, which are not, unfortunately, going to show what these are for. So here on Morningstar, they call them capital leases. On the press release, which is the more official thing, they call them operating leases. So these are more official. I would go by these and what they say because this is a press release directly from the company. So these are operating leases, which are treated, so capital leases are treated differently than capital leases are treated differently than short and long-term debt, and operating leases are treated differently than both. So what I would do here is I would need to figure out how much of this $21.7 billion is due within the next year. And then I would capitalize that by multiplying it likely by 7, depending on what it is, to find a value, an estimated value that this would subtract, I guess, is the best way to put it, from the value of the company. Yeah, and so they're not going to talk about it in here. And the press release is out, but let's see if this is the actual 10K. Where did it go? There it is. And again, I'm taking a little bit longer here because this exact process I would go through with any stock I look at. If I find something interesting of major note, oh, it is the 10K, yay. then this is the process that we'll go through. So since we know that's an operating lease, this is a big deal. So they're transforming how they use their real estate, which being a brick and mortar company is going to be a massive deal. This, again, to the tune of, at this point, $2.1 to $2.4 billion. Frankly, I would say that's probably going to be higher, just because these kind of estimates by companies or governments are typically always end up higher. Includes $166 million in impairments relating to operating lease right of use and finance lease assets. So what this likely means, again, we'll find out more when we get to the footnotes, is that they had to pay penalties of some kind to get out of contracts when this COVID stuff hit. That would be my guess. Also, made before commitment. Okay, nothing majorly important there. Okay, so when you are looking at operating leases or these kind of obligations, you want to see a chart that looks something like this. Contractual obligations and commitments. Comes under different names. It should look something like this. But so for example, what I would do here is this $3.5 billion less than 1 year. So they have a total of $31.6 billion in operating lease commitments total over, it doesn't say here how long, but it over the lifetime of their contract, they're $31.6 billion. The reason I use this number and capitalize this number is because things change a lot in a year, as we've seen in 2020. So I don't want to use the full amount here because, again, they could buy out their contracts. The landowner or the office space holder of these stores, I'm trying to figure out the right wordage here, could buy them out if they aren't paying their bills, could buy them out if they want somebody else to be there. So the things can change a lot, especially with the COVID stuff. So I would use this, and I would times this by 7. Why 7? Because most operating lease agreements are for between 5 and 10 years. So I go with the middle ground of 7. 2.5 times 7 is $25 billion rounded up. So I would subtract this from the value of the company. In essence, I would add this to the enterprise value of the company, but in a way it's subtracting that because this is an obligation you have to pay at some point, or you have to pay to get out of it. So note 1. Real estate expenses were insurance, maintenance, taxes, and rental payments were $761 million in 2020. Wow. Okay, let's see if there's anything else. So I have to probably go through their other financial reports, or I'd have to go through this one more in depth, maybe, to find out the specific reason, but it doesn't really explain why there's a huge jump in operating leases. Did they change their business model and how they kind of pay for the real estate in recent years? Because again, it shows right here, operating lease right of use asset. August 31st, 2019, there's 0. Then there was an adjustment as revised September 1st, 2019, it's $21.5 billion. So literally, according to record, 1 day's difference makes a difference of $21.6 billion. So was there accounting rules and regulation change? Was there, do they do different things differently with their stuff? Again, I'm not going to bore you to death because that would require going into the company financials in more depth. I don't want to bore you to death. But these are things that I would look for and make note of if I was to look at Walgreens. But to sum up here, actually, we need to look at valuation slowly. To sum up here, as we begin to look at valuation, CVS looks like the far better investment. Far better investment, frankly. And it's cheaper. CVS is cheaper than Walgreens. Frankly, yeah, CVS looks like the far better investment. It's cheaper, it makes more money, it's more profitable. Is CVS a great investment right now? To find out, go to my thoughts on that at the link below this. But Walgreens just looks like it's getting outclassed, frankly, by CVS in pretty much every facet. And I would stay away from Walgreens right now because of that. So I hope this helped. I hope you found this interesting. I hope you learned some stuff. If you want to learn from those other videos I mentioned in this video, make sure to check out those in the links below. Make sure to get also the 5 free gifts, free PDF copy, or 5 free gifts, which include my valuation and profitability metric template. You can get those 5 free gifts, free PDF copy of my book, How to Value Invest, and our guide, 7 Tips to Picking Great Stocks. You can get all those things at the links below. And if you're watching on YouTube, like, love, share, subscribe, all that good stuff. Would really appreciate it. And if you hit the notification bell as well, because then you'll be notified anytime we release a new video, and release new videos all the time. If you're listening on the podcast, like, love, share, subscribe, all that good stuff. Make sure to, if you could leave a review, we'd also really appreciate that, because the more reviews, views, and listens we get to our content, the more people we can help. I do have to say that this is for educational purposes only. I don't own stock in any company I mentioned in any of these videos, and I don't short sell in companies that I talk about negatively. And I have to add this disclaimer in here because some people did not like my first couple of videos where I was talking negatively about a company they liked. So this is my personal thoughts on these. I just have to put that in here. But until next time, have a great day. Talk soon. Bye.